We're going to take a look at the Shiller PE. That valuation is really high, along with the normal way that people look at the valuations for the stock market. We think the second half is going to be rather tough as all the interest rate increases starts to hit the economy. And over my career of 37 years of managing portfolios, it's always when the calendar shifts for whatever reason from like one quarter to the next, it takes on a different sentiment. So we're a little concerned as we enter into the third quarter, as we get closer to when those earnings have to come through, that it's going to be a tough period for the stock market. With the Federal Reserve meeting last week, it was rather surprising where they talked about raising rates another 50 basis points. We kind of thought they would be more dovish, talk more about they've done a lot. We'll have to see what the data looks like going forward. But the consensus of the Fed was they're going to raise another 50 basis points this year, and kind of gave the signal, I thought, that they were going to raise rates 25 basis points in July. As you probably know, we don't think the economy could handle any more rate increases. And the fact that the yield curve is so inverted that this is really negative for the banks if interest rates continue to rise on the short end. They're really getting squeezed for deposits. Man, I was at US Bank over the weekend, and they were offering some really attractive rates on some of their money market funds. The stickiness to the 10-year has been very beneficial to the valuations of the stock market. So as the 10-year stays kind of where it is, the valuations of the stock market can support the PEs where they are currently. So you need earnings growth to take off at this point. So the 10-year Treasury has been in the range of 3.4 to 3.8%. Now, if it goes much higher than that, it's going to be a problem for the stock market's valuation. Now, here is the yield curve. So this is the very short end, the 1 month here at roughly 5.2%. If you go to 4 months, you go to 5.4%. You go here to the 10-year, and you're at basically the lowest part of the yield curve, which is roughly 3.8%. So the 10-year at 3.8, what that tells you is that the Fed is expecting, or excuse me, the market is expecting roughly 3.8% nominal growth. So real growth plus inflation over a 10-year period to get to 3.8%. That's a very negative view. Certainly doesn't reflect the high interest rates that the Fed is trying to put into the economy and the stock market. So if people get very optimistic about the economy, that's going to push this 10-year up, and the market cannot support the valuations as it is currently. So looking at the valuations, the Shiller PE 31 times, that's a really high level. So here's the Shiller PE. So back in 1929, it got to 30 times. Obviously in 2000 was much higher, close to 45 times, but that was an extremely odd period. And kind of where we are currently, I kind of lump all this in together, is we're roughly at 31 times earnings, and there's a big dichotomy between a few select stocks and technology and the rest of the market, but the entire market itself is at a very high multiple. So it cannot support higher interest rates from this level. Now, the current PE of the market is roughly 20 times 2023 earnings, and then roughly 18 times 2024 earnings. So there's an old rule, it's called Rule 20. You take 20 minus the inflation rate, and you get the PE multiple for the stock market. It's been very consistent over time. It works really well, actually. So you take 20 minus where the Fed wants to go, 2% inflation, you get 18. So in our opinion, the stock market is now roughly fully valued on 2024 earnings. You could argue that if the 10-year Treasury at if it goes to 3.5%, so the yield goes down a little bit, it can support 20 times earnings. Now the economy, the Fed in their discussion last week, they basically, the consensus of the Fed was they expect roughly 1% GDP growth in 2023. We think that's in the ballpark. You know, the front half probably to look much better than the second half. So the front half, you're probably going to see 1.5 to 2.5 sort of GDP growth. And then the back half of the year, you could maybe see the mirror image of that negatively. So somewhere between 1 and 2.5% in the second half of the year. Depends on how badly the banks react to this inverted yield curve. Obviously, the banks don't like inverted yield curves. It's easier for them not to lend money, take the interest they get off a short-term treasury, and be conservative and not have any bad loans that they're making at this point in the economy. So why has the economy not fallen into a recession this year, I guess? But looking at last year, it did. There was 2 quarters, back-to-back quarters, where we had recession. The market, S&P 500, fell 25%. The NASDAQ off 33%. So why haven't we double dip in 2023? That was our original expectation when we wrote our white paper on inflation back in early 2020. So our thought process is why it hasn't gone into recession yet is a couple of factors. The first factor is the Fed raised rates so quickly, the market hasn't had a chance to incorporate those higher rates into, you know, real costs for the consumer or the corporate sector. But it will. It'll happen. And then the second reason is the labor market's been strong. Now, the labor market, in our opinion, is showing some signs of weakness. So labor is a coincident indicator. So if the labor is weak, then you're likely having a bad economy. If the labor is strong, you're probably in a good economy. It doesn't predict anything, so it goes with the economy. So we've seen initial claims pop up quite a bit. So what initial claims are is the first time that person's filing for unemployment benefits. So you lose your job, you go file, you get unemployment. And probably a lot of people haven't filed because they got pretty good severance. But if you look here, back in 2022, late 2022, we were down around 180,000 claims, so somewhat low. And then now we're up to over 260,000 claims in this latest report. It's considered to be a recession when you're at 300,000 in terms of claims. So we're getting there. So if the initial claims, you should watch this closely, goes above 300,000, we're pretty confident we'll be in a recession at that point, and we're thinking that probably that'll likely come in the second half of 2023. So what do we do with all this? The stock market is getting to the point of the fundamentals now have to deliver. So we've seen this massive cut in earnings, massive, right? From 250 in earnings down to 221 roughly for the year, $221 for the S&P. You can see here that the second quarter was roughly flat with the first quarter, and now the third quarter expects a pretty large jump here. So the third quarter is up about 6% versus the second quarter. And then for the whole year of 2024, it's expected to be up roughly 12%. So it's a little hard to believe. So what happens generally is you probably have noticed that a lot of corrections or bear markets occur in the second half of the year in August or September or October. And that's because of the seasonality of analysts cutting their estimates. We think that there could be a pretty good sized cut here in the third quarter and for the fourth quarter, and that'll also bring down the earnings estimates for 2024. So the positive about the market is there are cheap stocks. There is a technology revolution occurring, which is good for the long term, and it'll show up in productivity of companies at some point. But the stock market valuation does not reflect a recession in any way. The bond market does. So the bond market is the Fed's being overly tight. I mean, really, what a huge inverted yield curve. The economy cannot break the grips of that inverted yield curve. It'll succumb to it. So at some point in time, the reflection of lower earnings are going to have to be made by the Wall Street analysts, and then the valuation will be too high for the market. So we were expecting perhaps that would occur in the first half of the year, but it's probably occurring in the second half of the year where it really matters. The market's been good this year about looking through into next year, but next year, this is where the analysts will start to say, am I right on my numbers for next year? Probably when the third quarter earnings are reported in October. So the big picture here for us is second half going to look a lot tougher than first half. We like treasuries yielding over 5%. That's a nice place to be for, say, a 6-month period of time. And then use inverse ETFs, which is we do. We use inverse ETFs to protect the downside of portfolios. If you want to speculate, well, use the charts. Remember, as you start to break those moving averages, you can start to get more aggressive. But it's a risky thing to do, and we don't promote that. But if you want to protect your portfolio, it's not a bad time to take a European vacation or whatever you want to do. Protect the portfolio, buy some treasuries, and let it play out. Thanks a lot. Take care, and please hit like if you like our video. And if you want a hard copy of Mark in a Minute, please go on my website, Patrick Adams CFA, and then fill in the form, and we'll send that to you on a weekly basis. Take care.